The stock market is going through a rough patch, and uncertainty seems to be everywhere. When times get tough, I find it useful to turn to the wisdom of successful investors who have navigated the market's downturns before. And one of the best sources of financial insight, of course, Warren Buffett. In today's video, I want to share some, or at least one lesson from Buffett on handling market volatility. His advice may surprise you, but it's incredibly valuable, especially in times like this. But before we jump into that, let's first look at the bigger picture. How bad is this situation really? Putting the market drop into this perspective, as I'm recording this, the stock market's taken a significant hit. The S&P 500 had shred trillions in values. What's behind this? A combination of economic uncertainty, shifting trade policies, and investors' anxiety. For example, recent tariff increases have heightened tensions between major economies, and that kind of unpredictability makes market a little jittery. It's easy to feel overwhelmed when you see your portfolio shrink, but this isn't the first time we've faced a market correction. In fact, corrections of this magnitude, they're quite normal. The key is not to let your fear drive your decisions. Warren Buffett's timeless advice, Buffett always has emphasized the importance of keeping a level head during a market turndown. He once referenced the famous poem, "If you can keep your head when all about you are losing theirs." That's the mindset you need to cultivate. Investing isn't about reacting to every market dip. It's about staying the course and making rational decisions based on long-term strategies, not short-term fears. So what should you do right now? How can you apply this wisdom to your portfolio? Well, here are some strategies. Stick to your long-term plan. When the market has stabilized, you likely have a strategy in place. Your ideal balance between stocks and bonds, they make sense. Are you still aligned with this strategy? If so, remember that staying invested is often the best course of action. Trying to time the market rarely works, and even the best investors will admit that they can't predict short-term movements. Avoiding becoming a forced seller. The biggest mistake investors make in a downturn is selling out of fear. And the common reasons that people sell when they shouldn't, well, needing cash for living expenses. If you're relying on stock sales for income, price markets can put you in a tough spot. Emotional panic. When anxiety takes over, selling can feel like the only way to stop the pain, but this often locks in unnecessary losses. Make sure you have a two-bucket approach to retirement. A portion of your money is placed in a growth bucket, and a portion of your money is placed in a protection bucket. This strategy is when the market's down, you're taking money out of the protected bucket, where you can't lose money, CDs, high-yield savings accounts, fixed annuities, money markets. This allows your money in your growth bucket, aka in the stock market, time to rebound. Your retirement years, it's smart to have guardrails or downside protection on the money that's in the stock market, as you can't afford big losses. A proactive plan. You certainly don't want to run out of money. You don't want to end up being a burden on your loved ones. Bottom line, the stock market corrections, they happen. It's a part of investing. The key to success isn't avoiding them altogether, because that's impossible, but rather to have a plan that allows you to navigate through them wisely. Put yourself in a position that you don't have to make rushed decisions under stress. Thanks for watching, and I'll see you next time.